Hello everyone, you are on the Franklin Trade channel. Today we will talk about a popular but quite risky technique that traders often use in binary options. This is trading with martingale strategies. If you are already familiar with the market, you have probably heard of this approach. For beginners, I explain that a martingale is a strategy in which a trader increases the amount of the subsequent trade after a losing trade to recover losses and turn a profit. But like any strategy, the martingale approach requires discipline and the ability to manage risks. Today, I will explain in detail and show how to use martingale strategies correctly and not lose your entire deposit. Let's start analyzing the market. In this case, we have the euro-dollar, a great wonderful currency pair. We had a support level, we have a trend level, but we have already broken through it and the price has been gradually falling down. Previously, we have opened positions here, in the previous video, or during the trading session. Well, we have already broken through this strong level, and the price is just falling down with tremendous force. Therefore, we choose our currency pair and open a position for a decline, at least down to the previous low. There we will look for support and possibly an attempt to reverse. Well, we will discuss this furthermore. Let's remove the old levels. We don't really need them. Now, let's take a look at the RSI indicator, which for some reason is not showing up here. We need to go back into the indicator and select this wonderful indicator. We have it, and it really helps to see the overbought or oversold conditions of the market. So, the bug has been fixed, and we can now open our panel. We will remove the old panel because it has incorrect parameters, and I have slightly better parameters. In principle, it was even noticeable for a second. The price is already approaching the support level on the RSI indicator. It's around 20. I think the price will drop even lower, and then we will look for a reversal there. The reversal can happen at any given moment. Therefore, we will open a position with a significantly increased volume to cover the loss. One could definitely say that we entered quite early. Let's take a look further. The British pound and Canadian dollar also look interesting. We have a strong level. We have a support level on the RSI. Well, that's that. Let's keep looking further. While I look further, let me tell you about the essence of the strategy itself. And it is quite simple. If your position closed in the negative, then the next position is opened in the same direction, for example, with an increased amount. The main idea is that if your previous prediction did not come true, the market will eventually correct itself in the right direction, or you may have simply encountered a correction. This happens, and it is evident in the market, especially in a strong trending market. And then, the profit from the increased position will cover the previous losses, and you might even be able to earn a little. But for beginners, I advise that you simply cover the loss and not increase the risks. At first glance, this all sounds very tempting, but in practice, there are a whole bunch of nuances. And for the British pound against the Japanese yen, we are opening a position to sell. We also have a strong trend here, along with a slight correction, which I just missed entering, but it's not a big deal. We are starting with a larger volume right away to cover the loss from the previous trade. The market is good today, and I think we will achieve a very good profit. Well, I think it's important to start by calculating the amount of the trade. To successfully use the martingale strategy, you need to clearly understand what portion of your deposit you are willing to stake. You shouldn't increase the amount by 2 or 3 times without any preparation. It's simply unsuccessful. It's better to use special formulas, such as martingale. This is a capital management system in which each subsequent trade is increased by a certain percentage or factor to cover only the previous losses. For example, if the first position was $100 and closed with a loss, the next position can be opened for $150 to cover the previous loss. If you open a position for $200 with a payout percentage of 92%, you will not only cover your previous loss, but also make a good profit. But remember, this is a very heavy burden on your deposit. It is very important to keep in mind that the larger the amount of the trade increases, the higher the risk of losing your entire deposit if the trend continues to go against you. Under no circumstances should you work with this methodology based on intuition or simply because you feel like opening a position here. All of this should work in conjunction with technical and fundamental analysis, at least support and resistance levels, trend lines, breakouts, flags, or any technical analysis patterns that you like and can practice. Now let's talk about the timing for catching up. Many traders make the mistake of trying to catch up without a clear market analysis. believing that the price will definitely reverse. This is a very dangerous approach. It is always important to rely on technical analysis. Use indicators such as RSI or MACD to understand where a price reversal may occur. For example, if the RSI shows that the asset is heavily oversold or overbought, as in our cases that we are currently trading, that is, the probability that the price will go up soon, and this could be a good moment for catching up. But if the market continues its trending movement, it is better to refrain from further catch-ups and simply reassess your strategy. In the next part of the video, we will review our strategy because the market has turned a bit, for example, with the euro-dollar. And here we will have to open a position for an increase, because sometimes the market reverses, and at that moment it is very important to change your opinion. Because, as we can see, the euro-dollar looks very bad right now, and we have hit that true reversal. And I'm not recording this video for nothing under this text, because we will definitely have a very powerful overlap here. We will cover our loss a bit, specifically just our loss. Our position on the pound of Japan closed, and we made a very decent profit. This is very encouraging, so we have already recovered part of our loss. Therefore, we will continue to work, and I will continue our conversation. Because a very important aspect is the selection of assets and time intervals. Trading with catch-ups is best suited for assets with high volatility, where the price frequently changes direction. These can be currency pairs such as euro-dollar or commodities, but we do not trade them. I mainly advise trading on currency pairs that move very well, such as the Euro-Australian dollar at the moment, which is about to break a level. It is also important to consider the timing of trading. During periods of low volatility, when the market moves within a narrow range, catch-ups may not work. It won't work because the price doesn't reach the desired level. It may just stay in place, and your entry will simply be a matter of luck. I recommend trading during active sessions, for example, at the intersection of the European and American trading sessions, when the market experiences the highest liquidity and movement. Essentially, these are the times when we have trading sessions. If you didn't know, I have a Telegram channel where we trade and earn money, and if you want to join the team and start earning as well, be sure to definitely message me privately, and we will talk and start productive work together. Now we should also talk about psychology. Trading with martingales is a very stressful strategy, and it is important to be psychologically prepared for potential losses. Many traders, especially beginners, start to panic after a few unsuccessful attempts and continue to chase losses completely thoughtlessly, which leads to a total loss of their deposit in a very, very short time. It is important to keep a cool head and strictly follow your plan. If you feel that emotions are taking over, it is better to stop, take a break, and reassess your actions. In trading, not only the ability to analyze the market but also the ability to control emotions is very, very important. Another important aspect is risk management. As I have mentioned before and continue to say in my videos, trading with martingales can quickly lead to significant losses if capital is not managed properly. I always recommend setting strict limits on the number of martingales and the amount you are willing to stake in each trade. For example, you can limit the number of martingales to 2 or 3 and not risk more than 5% of your deposit in total across all your trades. Again, I emphasize, always use a minimal percentage of your deposit. This will help minimize risk and preserve the deposit even after a series of unsuccessful trades. In conclusion, I want to say that the martingale strategy can be very effective with the right approach, but it requires discipline, knowledge, and the ability to manage risks. You should not rely solely on luck. Always analyze the market using technical indicators and technical analysis. And be sure to keep an eye on the news that could affect the price of the asset or even reverse it in the moment. And most importantly, control your emotions without violating risk management rules. In practice, we already see that martingales work very, very well in skilled hands and during strong trends. The euro-dollar has turned around, and the price has increased significantly. There were some gaps and a slight pause, but then the price shot up significantly, and we took our profit. Our volume increased well enough indeed, and we also received a good profit. Friends, don't forget about my YouTube channel, and don't forget about the Telegram channel where we trade and earn. Join my team, and let's start making money in this wonderful market. Thank you all for watching. Goodbye.